Roger Freeman joins us from Barclays Capital. And let's bring in Michael Kim of Sandler O'Neill as we prepare for a good half-hour conversation. Michael, come on, don't be afraid. You know, I'm not a bear market. Michael and Roger with us as we prepare for a lengthy conversation with our Christina Alessi with Mr. Kravis. Who is Henry Kravis within the investment sphere, Michael, that you cover? When someone says the name Henry Kravis, who is he to you?
Well, I think he's the founder of private equity. Certainly KKR is the original private equity franchise out there. And he's got a tremendous track record, and so I think when people talk about Mr. Kravis, it's really talking about private equity in general.
The stereotype, Roger, is a little bit of cash and a lot of debt called an LBO. These firms are very different now than the stereotype we have from movies of long ago, aren't they?
They have. They've evolved a lot, and you know, and they built out businesses beyond their traditional private equity as well, and notably KKR and others have been building liquid markets businesses in the credit area, and that's been giving them a lot of opportunity in this environment.
Roger, I kid our Christina Alessi about internal rate of return as a measurement here, a little bit different than the return we have on a mutual fund. Is Henry Kravis and others, are they living in a single-digit return world, or can they still make ginormous amounts of money?
We think that they still can earn returns in the range of what they've done historically, and I believe KKR has been, you know, in the mid-20s from an IRR perspective. You know, the reason, and that sounds like a high bar in this environment that we're in now, but you know, this model lets investors like these time their entry and exit points, and that's a huge advantage that they have over asset managers that are trading the markets on a daily basis.
Do you agree with that?
I do. I think, look, the reality is that the slowdown in global economic growth, right, the uncertainty around the volatility of the broader markets, that's going to pressure earnings in the near term. But like Roger said, over time, we think KKR, along with the other private equity franchises, can continue to generate outperformance. They've done it across cycles, and so I see no reason why we shouldn't expect that to continue.
Here's a dreaded first chart, which has nothing to do with KKR. Well, maybe it does. Maybe Henry's going to buy a copper mine. Copper is global thermometer, and you can see here the plunge down. Roger, we see the big plunge down in the copper commodity and then the trading range bound here. Are you modeling, Roger, your spreadsheets, are you modeling them for recession right now? Or can we have an economy that will sustain where the KKRs of the world keep doing business?
Yeah, our models assume a modest return relative to what they've done historically. I believe we have about 10% return assumption on their overall asset base next year, which again, relative to what we were just talking about, would be a low number. So yeah, we are certainly modeling as a firm. We have a very conservative outlook with respect to global economic growth, and that does factor in. But you know, we don't model the underlying companies in their portfolios because we don't have enough data to do that. We do take a macro approach to modeling overall returns.
Michael, we look at, I'm watching the Greece headlines, folks, to see if we see anything coming out of Greece. Michael Kim, when we look at the ability to put money to work right now, I like how you put that in your report, putting capital to work. We have a squeeze going on. Let's look at this chart, Euribor OIS. Here's a litmus paper for Europe, and you can see, okay, there's a little bit of Lagardian IMF movement there. We've done a little bit better on that important short-term spread in Europe. When Mr. Kravis talks to Christina, is he frustrated today that he can't put capital to work?
No, I don't think so. I think clearly KKR has got ample capacity to put to work with their existing funds. I think the pricing levels are getting more attractive, so that certainly helps from a deal flow perspective. And then finally, although the credit markets have backed up more recently, I do think that financing is available particularly for the bigger firms.
For KKRs of the world.
For the KKRs of the world, exactly.
Right. Roger, I listen to these names. I'm just going to peel them out here. Beatrice Foods, Safeway, Duracell, of course, RGR, Nabisco, and Barbarians at the Gate, Hospital Corporation of America. Where are these firms looking for now? Are they looking at industrial companies with foreign revenues? Are they looking at foreign companies? Is there a category of company that is in now for private equity in M&A?
I wouldn't say that there's a particular industry subsector that is the area to invest in. I think I'm just thinking back over the last 2-3 years how the industry has evolved, or the areas of interest, and it had been a lot more international. I've sensed some pullback or greater interest in the U.S. again, given that equity valuations have come in. But I think the basic tenets of a good business to invest in, i.e., one that has a strong brand, has growth, attractive growth on its own, but that can have profitability enhanced by being taken out of a public sphere, regardless of the industry, I think is of interest.
You get to ask Henry Kravis a question right now. What would you ask him?
I think, I guess the question I'd ask is his view of the next 5 to 10 years in this industry, how businesses like him are going to evolve, and specifically, what I think is an interesting topic point is the opportunity set for firms like KKR in the new regulatory environment. When you factor in Dodd-Frank and
right.
Basel III on the banks that are going to curtail or cause them to pull back on some of their businesses, particularly in structured areas, what that might mean for a firm like KKR, particularly with a balance sheet that they have. They have a fair amount of capital they could put to use.
I mean, you and I were talking about this on the break. Same idea, the strategic vision these guys have. Is it really now Advantage Evercore? I mean, even BX, but Advantage Evercore, Advantage KKR. Are they in the sweet spot given how the too big to fails are to be kind challenged?
I think so. I think, and maybe the question that I would ask Mr. Kravis is really how he envisions continuing to diversify the franchise. They've made inroads in terms of building out their hedge fund capabilities, real estate capabilities. They've got a burgeoning capital markets business. So I think just his vision for building out the franchise over time.
Let's look at the chart of KKR. Let's bring it up. I want to talk to Michael Kim about this. Kravis considers an alternative. So here's like an IPO-y kind of thing, and up we go. Boy, things are great. I mean, and then less so, and over we go. Everybody wants to go public here, don't they?
I think over time you're going to continue to see equity and alternative franchises continue to go public. I think having a public currency to attract and having a permanent capital base are clear advantages for being a public company. Roger,
when we look at what KKR is doing and the idea here of performance, what do you presume rather for the next 12 months? Do you have a buy on the security now?
We do have a buy on the security. Look, I think this industry is at an interesting crossroads because there aren't many of these public firms, and until recently there were really very few. Right, the industry started IPOing in 2007, got cut off with the credit crisis, and never really became a full-fledged industry as far as investors were concerned. And there's some accounting anomalies and lack of float, given that most of these stock is held by insiders, that have kept investors away. So I think more of these companies now, and you throw KKR and Apollo in there, and others potentially set to come, is going to expand that universe. So I think that actually ends up helping the stock. And then broadly speaking, it's just going to be a better capital markets environment, better economic growth is going to drive these stocks higher.
Oh, we lost our audio there. 2-minute minor. Our audio's there. It is 2-minute minor for the audio staff. Michael Kim wired up again. We thank them for the effort. Look at this chart, Michael Kim. This is remarkable. Goldman Sachs. It's an elegant chart. Goldman Sachs and KKR normalized back to the beginning of KKR's effort here. I mean, that really does. I was surprised by this. It really does explain yeah, how much KKR's given up, but they've really outperformed a given major bank, haven't they?
That's right. And I think a lot of the initial outperformance had to do with the fact that KKR relisted on the New York Stock Exchange. Institutional investors, or the opportunity clearly opened up for the stock, and people were getting their hands around how to value these franchises, and over time we've seen the stock do well. Now, more recently, obviously, the stock has come in along with the broader markets, but we still see some pretty good depth of value going forward.
As we go to our conversation, Roger, you want to jump in there. I see you want to jump in.
Yeah, I just want to add to that, because I think actually look at the recent stock price performance, and it reflects, I think, and see if Michael agrees, that the market still doesn't really understand these companies. Because
thank you. Continue, Roger. Yeah, continue. You're right.
The point is that. Yes, capital markets have become much more challenging. I think investors look at, the IPO window having closed here, hopefully temporarily. Concerns about whether financing is available, and ability to raise capital. The reality is that these kind of environments actually make prices cheaper, give them opportunities, and they have the luxury of time. They can sit there. They can sit through 3 months, 6 months of bear market conditions. It doesn't really matter, because they're driving IRRs over an 8 to 10 year period on their funds.
Right, Michael. When you look at this, as we go to this conversation, part of this misunderstanding of who these firms are, to me, is almost cult of personality. Of Henry Kravis or Roger Altman, and you know the names better than I do, or Pim Fox knows them better than I do. Is there a problem here of its cult of personality, or are these personalities really dominant?
I think the personalities certainly are dominant, but I think what you'll see over time, and the IPOs of these companies, or the public listings, or the first stage, is really transitioning the ownership to the second generation. They've got the infrastructure in place to be able to do that. So I think key man risk, if you will, continues to decline for most of these franchises. Very good.
Michael Kim, thank you so much. With Sandler O'Neill, Roger Freeman with Barclays Capital. I think a smart discussion here on KKR.